Going on to our next presenters, Corellian, who I'm sure many of you will be familiar with if you've attended the Sunday night pre-market open webinar where they share their expert insights across the fundamental and technical spectrum. With careers at the likes of UBS and HSBC, to name a few, both these gents have a wealth of knowledge to supply in this evening's presentation. They will now provide you with their views on the first half and the trading possibilities therein. So I'll hand it over to Corellian.
Okay, hi. My name's Maurice. I'm the sort of strategist for the company and the mentoring team. And what we wanted to do for you tonight was, in the limited time we've got, and talking macro is not easy in a limited time, I assure you, but we're going to sort of give it our best shot here, and we're going to start off looking into the first half of the year from our point of view. And I think what we want to start with is stock markets and what we think that may be happening for stock markets. I'm sure a lot of you are trading these. And you've seen at the start of this year that things have changed quite dramatically for a lot of good reasons. So we have to ask ourselves, what impact will rising interest rates and the removal of liquidity have on equity markets? Now, if you remember, what has got us here since 2008 is interest rate suppression, which is forcing yields down to zero. So the likes of us all can borrow cheaply and spend money and keep the economy going. It was also a massive bailout of the banks, which seemed right at the time. But it has to be said that this has been going on for an awful long time. We've had very, very loose financial conditions for a very long time. And the impact of COVID and everything else has changed a lot of the dynamics for many of these economies. And so what we have here is now central banks caught way behind the curve, who are struggling now to sort of try and find a way of moving financial conditions to a tighter structure so that they can try and cap some of this inflation. Now, the problem is they can do nothing about microchips and they can do nothing about ports being blocked in China. But what they can do is attack the demand side, which is where the financial conditions come into play. So what you're seeing here is a lot of questions about how far the central banks will go. Now, at the moment, and listening to Powell tonight at the Fed, they don't know, but they are going to have to do something. For goodness sake, they've got zero rates, 7% inflation, and real interest rates, which are nominal yields, nominal rates minus inflation, deeply negative. And in the European Union, it's even worse. Negative interest rates and negative real rates and 5% inflation. It's ridiculous. So something has to change. Now, the problem is if you tighten financial conditions, equity markets are going to struggle because that is the drugs that got them here. So obviously it was pretty clear, and people say, well, they're still doing QE, which is a fair point. But the markets are forward looking. And the Fed has told us they are going to start acting in March. The Bank of England has already moved. The RBNZ has already moved. Many others have already moved. So we're at a sea change here. And so therefore, there will be some act of reaction, if you like, on equity markets. And volatility is one of the things that is not the friend of long-term investors. We've got a lot of it at the moment, but not all will follow the same path going forwards. So, with the ECB slightly more dovish, refusing to move, the Bank of Japan, uber dovish as ever, probably unlikely ever to move the way they seem to be talking, but that's another thing. But what we have got here is that some of the people see opportunities in other markets. We have overvalued US markets and we have better value possibly elsewhere. Although, unfortunately, when US equity markets fall hard, generally global markets go with them. But we are seeing some signs of some slight outperformance by the likes of the FTSE and up to a certain degree at the first couple of weeks of the year, the DAX as well. But that could all change if these markets keep plummeting. And we're having a bit of a reversal back away from the highs tonight. So that's me on just a fundamental structure. But I want to bring in Richard, who's going to talk to you about some of the interesting developments in the technical setup for these as well, because they seem to be aligning quite closely with the fundamental outlook as well. So I'm going to pass you over to Richard, who's a real specialist on this subject. Rich?
Great. Thanks very much, Mo. It's obviously been a very, very significant time over the last couple of weeks for the S&P. And within an outlook for the first half of this year, We have to look at the longer term charts, and I'm going to start by looking at the S&P index on a weekly basis, just to put into some sort of context of where the market has actually fallen from. But for me, technically, this period of the last 3 or 4 weeks or so reflects quite an important sentiment change for equity markets, particularly in the US. As Mo's mentioned, obviously elsewhere we may see relative performance, but if we do see the US markets selling off aggressively, then that will affect other markets as well. So I think it's going to be very important to concentrate on this chart. Now, as a technical analyst, it's probably going to surprise you when I say I'm not a great fan of trend lines, or in particular trend line breaks, because for me, they tend to reflect the possibility of something changing, not necessarily an immediate signal. And what I mean by that is that we need to see further evidence of a sentiment change, which may well first be reflected by the trend change. Now, these trends I've drawn here, all legitimate trends, connecting lows, so on and so forth, but it's only the green trend, the final trend, that looks as though that may well be having a more significant implication in terms of a sentiment change. Now, for me, what's most important within price action and within a trending market is that each correction finds support above the previous low. So in other words, we fulfill the most basic definition of an uptrend, which is higher highs and higher lows. And as long as we continue to develop that pattern, the risk is that that trend will continue, and we'll continue to see limited downside and the market rallying and making new highs once more. So the important shift, obviously, within the latest move is that we've broken this last correction low within the latest sell-off. So in other words, we've moved below the previous correction point from which the market has found support, rallied and made new highs. So the breaking of that trend is the first time we've seen the last correction low broken since March 2020. And for me, that is quite an important sentiment change in terms of price action. But also what is significant is that at the high, just over 3 weeks ago, within candlestick analysis, we also saw a bearish engulfing pattern. So in other words, we opened the week above the previous week's closing level, made a new all-time high, and for whatever reason, rejected that and closed below the previous week's opening price. So we bearishly engulfed the first week's open-close range. That was then confirmed by a further negative candle the next week, and this has resulted in further deterioration within the equity market and the sell-off that we saw last week. Now, couple this with the various indicators that we were looking at, as well as breaking that last correction low, seeing the bearish engulfing pattern, we've also seen divergence within both momentum and trending. And it's significant that it's both, because trending can quite often highlight divergences. But when you see it at the same time as trending, and then you break below the last correction low to confirm that divergence, you're looking at a much more serious and negative sentiment shift. So the evidence for me at this stage is that the first half of this year can perhaps see more significant selling pressure materializing. And within that type of backdrop, I will always draw Fibonacci retracements to highlight where potential correction points could be seen within a more extended sell-off. So drawing it from the March 20 low into the January 2022 highs, we can see that the retracements are coming in around 37.80 and the 38% retracement point. And that is the minimum or a normal correction within what can still be classed as a bullish trend. The midpoint stands at 34.79 or 34.80. So for me, the first half of the year could potentially see us back towards these retracement points, just as a normal reaction to what has been a very extended and prolonged move higher. But certainly the evidence over the last few weeks is that we have seen a more important sentiment shift, and that puts me on a very cautious footing for the next few months. So that's stocks. I'll hand back to Mo, who's going to look at the US dollar.
Thanks, Rich. Really insightful there. And one thing to remember here is that there's going to be a lot of volatility in these markets at the moment, particularly in equity markets. So you need to sort of think about your leverage, how much you're putting into these trades, where your stops need to be. You need a game plan. So make sure you're not just playing a numbers game here, and you give your research a chance. So looking at the dollar, this is a tough one at the moment. So one of the questions that I get asked a lot is, will the dollar react to higher US yields? Well, a lot of that depends on what other yields globally are going to do. But yes, I think we could be in for a move. Now, the interesting thing is, whilst 2-year yields are moving and the short end is moving on the potential for the Fed to start moving rates higher, the long end is not really breaking anywhere near this 2% level yet. Now, what does that tell us? That tells us that the forward-looking bond market in years to come is suggesting that there could be problems ahead with growth. And I was very interested to listen to the earlier speakers talking about this. I think they're quite right. There is a risk that we are hiking into a stalling economy, or at least a weakening economy for now. Bond markets are telling us that further down the line, there could be some real problems going forward here. But the Fed has to deal with inflation. There's a political drive there, which I agree with the previous speakers as well. There is political pressure from Biden to get this done. So they will have to act, but also they need to. For there to be an alternative to equities, they need to get real interest rates higher. And so that means they're going to hike, and they're going to keep hiking as far as I'm concerned. And you may see even one a meeting coming this year, depending on how bad things are. They've got a really tight labour market. But what does this mean for the dollar? Now, it is not always a given that the dollar rises during a hiking cycle from the Fed. A lot of it depends on what the economy is going to react to. So if the economy does start slowing down, you're going to see earnings possibly get damaged. You're going to see people with higher energy costs pulling back from discretionary spending. It could be bad for the dollar. So it's not clear, but there are signs at the moment through this risk aversion we're seeing that the safe haven is still obviously the US government bond market and the US dollar. So whilst we're seeing this sort of volatility striking, there is a danger that the dollar rises. But having said that, we've got some central banks that are yet to shift into a positive frame of mind to fighting inflation. The RBA and the Australian Central Bank is one of them. They've got quite hot data going on at the moment, and their last statement was quite bearish. So we could see individual pockets of strength against the dollar, like in the Aussie. And yet the euro, the Lane is still very dovish. He's the chief economist. Lagarde's still very dovish. They may be very slow to move. So there's opportunities here in some of the crosses as well. Don't just look at the dollar for opportunities in foreign exchange. But the dollar is rather mixed, but at the moment it's showing some signs of strength. And a lot of that is due to this risk aversion that we're getting at the moment. But where is global capital headed? Because that is a key component for the dollar as well. US assets are not as rosy as they were. There's not the US exceptionalism that is driving dollars into the US markets at the moment because they're having a bit of a wobble. Now, where will those dollars go? Is there value elsewhere? Is there less risk elsewhere? And this is something we need to keep an eye on. It's early days at the moment, and it's not clear what we're going to see. But if, for instance, we see a massive run higher in China or Hong Kong or even the UK, we could see these markets actually attract in some of those dollars, which could keep a cap on the dollar and see other currencies rally. But on a broad base, we are starting to see some strength. And on that, I'm going to pass back to Richard for you to have a quick look at this, which we're only covering with the dollar index, but bear with us on this.
Yeah, thanks, Mo. We're looking at the dollar index. Now, the first thing to point out about the dollar index is that it is significantly weighted towards the euro. It's about 65% or thereabouts. So when you're looking at the dollar index, quite a large proportion of it is based around euro dollar. So that's worth bearing that in mind. But I think the general themes and what Mo has sort of laid out is a slightly improving backdrop for the dollar, although it is still selective. And I think that is probably going to remain the case from a technical viewpoint as well. But when we look at the dollar index, we can see, and you know that my basic definition of an uptrend is higher highs and higher lows. Well, we've definitely got that within the dollar index, and with the move that we've seen subsequent to the Fed, then we're obviously sort of seeing further upside developing as well at the moment. So we have this pattern of higher highs and higher lows. We've got a bullish trending condition in place. Now, what's significant for me is that this upside move comes after this basing activity. So in other words, when we suddenly don't see a pattern of lower highs and lower lows, or a bearish trend, we tend to see a weak test of the previous extreme. And if we fail to extend below that point and then rally and break above the last recovery high, which is what the dollar index has done over the previous months, that is an indication that something is beginning to shift in terms of sentiment, and the risk is that we can see higher levels for the dollar index and the dollar in general. Now, in terms of potential resistance points within the first half of this year, then there really isn't, if we do start to take out the recent highs, there really isn't significant resistance, because the current correction has come back from this resistance laid down by the sideways trading activity. But if we start to take out these highs again, which certainly seems to be the risk, then we could be looking back towards the April 2020 highs, even the March 2020 extremes. So for me, what I'd now be looking for to develop this more positive dollar theme is momentum turning higher within this bullish trend. So we've got the slow stochastic here, the MACD. The MACD above zero basically reflects an uptrend. And while we're seeing that activity, the market is trading in a positive trend. Now, momentum turning up within that positive condition is often a trigger for extension of those bullish themes. So I'll now be looking for momentum to begin to turn up in a positive way within a bullish trend to really trigger this potential of further extension to the upside. And as I say, we could be looking back towards the April 2020 highs within the overall advance within the next sort of 6 months or so. But at this stage, this is still a more constructive picture. But we do at the current time need to be slightly more selective within some of the crosses. But I think the dollar is showing improvement, and the risks are for that to continue. So with that, I'll hand back to Mo, who's going to look at commodities.
Thanks, Rich. Really interesting stuff again. Commodity supercycle is a big topic at the moment. Have we got one? Well, according to Goldman Sachs, we're in one. I kind of agree, but I think the thing with this is that a lot of this may depend on just how committed governments are to their climate control spending. But we have seen the initial move higher in commodities since COP20 and all the rest of the commitments that were laid down. The problem is people like Biden are still struggling to get these spending packages through the Senate. So, when they do, and if they do, then I think we could see a further big gain for commodities, particularly those associated with climate change, like copper and some of the other metals. And to be honest, at the moment, we're also seeing food prices rise due to weather conditions in certain areas as well. So it's not a good environment for the consumer who's looking at some very hefty increases in energy prices, which again reduces their consumer spending potential. But this demand is tempered by a couple of things. A higher dollar, remember, most commodities, just about all commodities are dollarized. They're all priced in dollars now. And so therefore, a higher dollar has a negative impact on commodities. Now, if we do get a much stronger dollar, there is a danger that these commodities stall. But I think what can get us out of that is if we get these financial commitments down and happening on climate change. That is going to be a big game changer, I think, for commodities. Now, the problem is the supply on the ground, and remember that's different to the inventory in the ground, is in danger of being swamped as governments chase after raw materials to actually fulfill their commitments on climate change. Now, a lot of the mines can be restarted, but to rejuvenate a copper mine takes about 3 or 4 years. So there is a danger here that we have supply issues in commodities. And those raw materials are input costs to the economy. So that's a bit of a strong one as well. But the other thing that I think is really fascinating And listening to the guys earlier, Mark and Ryan, I know Mark and the other guy, sorry, his name escapes me, but I think, you know, they're quite right. You know, the inflation hedge with gold and crypto may be there, it may not be. I don't really have a view on crypto. Gold is not the greatest hedge against inflation on the planet anymore, but commodities are. And I think hedge funds particularly, and certain asset managers now, the old 60-40 equity bond ratios that they used to run are dead in the water. You don't have 40% of your portfolio in bonds. And they've replaced some of that, I think, with commodities, because you've got to have some on your portfolio on a macro basis, not only because of the demand that's coming up and the returns you can make out of it, but it is a pretty good inflation hedge. Commodities go up when inflations go up, but also we're going to have this new driver behind commodities as well. So if I was looking past the first half of this year, and I know I'm supposed to be talking within the first half of this year, the macro picture looks pretty good for commodities, but a lower dollar would help, and the spending bills being passed in the US would be a kicker, and then we need to see if the rest of the world follows. There is some commitment to this. The only thing I would say about that is that the governments are not aware, in my opinion, of just how much they are going to have to spend to get this right. And that means a massive fiscal boost to the economies coming up, which then could be more inflationary, which then does all sorts of things with interest rates as well. So commodities are a real key here, and you need to be aware of what's going on. So get them on your screen, keep an eye on them, and some of them make great investments as well, and some of them are quite good to trade on a shorter term basis as well. But they are important, so just bear that in mind going forward. It's another one of those assets that can give you a signal, maybe a canary in the coal mine, if you like, sometimes, than when we see commodities move first. So it's another one of those things to sort of keep on your screen and be aware of how they react with other markets. On that, I'll pass over to the text with Rich, and that's it for me.
Great, thanks very much, mate. Excellent, as always. Here we're looking at the Bloomberg Commodity Index. Now, the first question you should always ask yourself is, okay, it's an index, what are the constituents? Well, the makeup of this, the highest constituent with a ranking of about 18% is gold. So obviously that is quite a significant influence in terms of price activity. But it is a very good measure of commodities in general. It gives us a very broad cross-section of softs, energies and metals, and gives us a great feel for what is going on within the commodity sector. So if it's an area that you just want to keep one eye on and what is actually happening, then it's a very good way of getting a feel for what's going on within the commodity market. And from a technical viewpoint, it basically, again, we're still looking at more positive themes that they've been in place. We've seen positive trending conditions since March. I think the risk is that we're starting to break above the recent highs, and the next we're standing around the 105, 106 area. The next sort of main resistance is 118, and then above that the July 14 high at 136. So I think, you know, the general positive themes are still very evident for commodities, and at this stage there's no significant evidence materializing for a reversal within the overall structure of commodity markets. So I think, you know, certainly the outlook, and I'll follow Mo by sort of extending it perhaps over the first half of this year, is for more constructive themes and the risk of us to develop this more positive trending condition. So that's pretty much the summary from us. If there's any questions, we'll be more than happy to answer them.
Thanks, Richard and Maurice. That was a great presentation. You covered a lot of ground there, some really nice mixture between fundamental global macros and technicals. There are some questions. So you were speaking earlier about that capital allocation, Maurice, and you know, there's a question here: will the reign of US equities outperformance, is it over? Given, you know, will that flow more to Japan and Europe, given the lower valuations and easier central banks over there? And I guess that also kind of dovetails into your levels on the S&P 500. I think I saw your first major level was 3.7K. will the Fed actually allow it to drop below 4K? So maybe Maurice, you want to tackle the first part, and then Richard, you can.
Yeah, it's a very good question. I mean, the problem is we don't know, and the problem is when we get US markets fall, it's different because they are the global benchmark, and so when they tumble, we often see global markets tumble with them. But as I say, when the dust settles and people understand what the Fed is going to have to do rather than what they're just saying they're going to do, because it's not clear even from tonight exactly where they're going to go, how far down that path they're going to go. But the thing is that there is a certain amount of US exceptionalism. We have had one of the strongest economies over there globally that we've seen for a long time. It is beginning to wane. Now, if that continues, I think investors will look for new grounds, newer pastures where there's greater value. And the places of the greater value certainly are, the UK has been underperforming since Brexit, let's put it that way. Yes, there's some political instability possibly coming up, but it is a pretty stable environment. And also the FTSE 100 is stuffed full of energy companies and mining companies, which are probably going to do very well. So yes, there's an argument that we do see capital flows, and they do move markets. There's no two ways about it. But I think this idea of where the flows will go, it's not easy to track, to be honest. We look for outflows of funds, and we are seeing some of the big ETFs losing quite a lot of status now in the US. That money's got to go somewhere, because it's not going to sit in bonds for very long, because you end up on a negative if you hold bonds for any length of time due to negative interest rates. So they are going to still be put to work. These funds need to be put to work. So I think there is a chance that the dollar is capped by some of these capital flows. The thing with China is they are easing, which helps, and the economy has got a potential to grow, but it's looking still quite a risky trade when they're still prepared to walk into markets and close companies down and close businesses down. That is not an investor's friend. So you've got to be aware that if you do go into markets like that there is a risk premium that pays you for taking that risk. And the problem is with what we've had with QE over the last 20 years is it's erased risk premium. And that's what worries me of going into riskier markets when there is no premium to be made for being in that risk. So that's why I think the dollar has attracted. I think that's why US assets have attracted, and they may continue to do so when this calms down. But I think the market needs to understand just how far some of these central banks may have to go to get this inflation genie back in the bottle. And if that's the risk of markets, I think the Fed is prepared to take that. Yes, the answer to your question, yes, I do think it can make that 38% retracement, because I don't think the Fed really cares that much about it. It depends how quickly it gets there. And I think it's not the level, it's the pace. And if the pace was very quickly, yes, it would be a problem. If it was gradual, I don't think they'd have a problem with that at all. Rich?
Yeah, I agree. I mean, I think certainly the first Fibonacci retracement at 3780 is the potential, the risk of the correction trade. And I think from the way the Fed would look at it, as Mo said, is the speed that we actually go there. Now, often when you see the first sentiment change, it is an acceleration. It is a very sharp sell-off. We take stops out. We then start to see people getting short. You will then see a reaction to it. So I think the risk is within this type of setup that it can be a steady retracement towards that sort of area. But that is certainly the potential within the current setup. And there will be rallies against any downside move. And they will offer opportunities at slightly better levels, at slightly higher levels. But I think it's, again, I agree, it's the speed. But I think this is fitting within a normal corrective trade, and that doesn't necessarily mean it's going to be an aggressive move. It can be a steady correction back towards that sort of area.
Thanks for both answering that question. I'd love to pick your brains on many more things, but unfortunately we're going to have to leave it there, and I'm sure the clients will look forward to your pre-market open webinars on Sunday.